If you stare at the financial markets long enough, it can feel like you're lost at sea. Red and green lights flash constantly, pulling your attention in 100 directions at once. For most traders, the real challenge isn't getting access to this data. The problem is filtering out that overwhelming noise so you can actually see the underlying trend. Look at this comparison. On the left, we have raw, erratic price action, pure market noise. But on the right, applying a moving average smooths out those same jagged spikes into a single continuous path. That single line acts as your compass. It shows you exactly where the asset's price has been, giving you a much clearer baseline to project where it might be heading next. But every trader faces the exact same tug-of-war. If you try to catch a new trend the second it starts, you risk getting tricked by a temporary fake-out. If you wait too long to be safe, you miss the profit. Today, we're going to weigh 3 specific tools that handle this trade-off differently: the simple moving average, the exponential moving average, and the triple exponential average, TRIX. Trading success comes from matching the math under the hood of these tools directly to your personal timeframe and risk tolerance. We start with the simple moving average, or SMA. It is the most straightforward and widely used baseline tool in technical analysis. Here is how the SMA actually works. It calculates the average price of an asset over a set period, say 50 or 200 days. And as you can see in this matrix, its engine treats every single day in that window with the exact same mathematical importance. Because a price from 6 months ago carries the same weight as yesterday's close, the SMA gives you a highly reliable, macro-level view of market sentiment. It draws the major support and resistance lines that large institutional investors actually pay attention to. But that equal weighting is also its biggest vulnerability. The SMA is inherently slow. Because it relies heavily on older data, it usually lags significantly behind a sudden market reversal. When you choose the SMA, you are making a specific trade. You are giving up the ability to enter a position early, and in return, you get rock-solid confirmation of a broad historical trend. But what if you trade in a highly volatile short-term market? Waiting for an SMA to slowly turn around means you miss the entire move. That brings us to the exponential moving average, or EMA. The engine here applies a specific mathematical multiplier, forcing the indicator to place far heavier weight on the most recent price data. By front-loading the math, the EMA reacts to current events almost instantly. It allows you to enter and exit positions much faster than the SMA. The cost of that speed is the whipsaw effect. You will frequently receive buy or sell signals triggered by a quick price spike, only to watch the price reverse a moment later because a lasting trend never actually formed. Using the EMA means accepting those false alarms as a regular cost of doing business. You are buying the ability to enter early, and you pay for it by taking on significantly higher risk. Eventually, many short-term traders hit a wall. They get exhausted by the constant false alarms of the EMA, slowly bleeding their capital across choppy, sideways markets. If you find yourself in that position, you need a stronger filter. That is the exact problem the Triple Exponential Average, or TRIX, was built to solve, operating as an advanced momentum oscillator. The engine under the TRIX is complex. It calculates the percent rate of change using an EMA that has been mathematically smoothed 3 entirely separate times. By running the data through 3 layers of smoothing, the TRIX completely strips away minor market jitter. It oscillates around a hard zero line, giving you a definitive bullish or bearish signal only when it crosses that boundary. But this heavy filtering comes with a steep price. Because the raw price data has to travel through 3 separate layers of math, the TRIX lags heavily behind real-time action and requires immense patience to trade. The TRIX acts as your shield against market noise. It cures whipsaw fatigue by forcing you to sit on your hands and wait for absolute trend confirmation before you risk a single dollar. Knowing the math is only half the battle. Choosing a moving average requires you to first identify your specific role in the market. We can map this out. Looking at this decision flowchart, start at the top. What is your primary timeframe? Are you measuring trades in macro months or intraday hours? If you take the macro path, long-term investors should stick with a tool like the 200-day SMA. Your goal is to ride broad market cycles, and this keeps you from being shaken out by daily noise. If you trade intraday, you have to ask yourself a secondary question. Are you currently losing capital to fakeouts and volatility? If the answer is no, and you are an aggressive day trader who needs speed above all else, drop a 9 or 21 period EMA on your chart to capture those rapid intraday swings. But if the answer is yes, and you're suffering from whipsaw fatigue, you need to upgrade to the TRIX. It will literally force you to practice operational patience. Using an indicator optimized for a trading style you don't actually practice leads to rapid capital loss. Theoretical knowledge must be practically tested before any real money is deployed. Take your chosen indicator and apply it exclusively to historical charts. This allows you to trade through years of data in a matter of hours without any financial risk. By observing how the moving average reacted to past market cycles, you learn to identify its specific lags and quirks before they cost you money. This process builds the internal confidence required to stick to your signals when the market gets choppy. Once you have verified the math through history, your ultimate weapon against market chaos is the relentless consistency to execute your chosen strategy every single time.